Hi everyone, welcome to my YouTube channel. Today we'll be discussing fixed income securities, fairly basic stuff. Hope you enjoy. Fixed income security. So, what is a fixed income security? Well, as the name suggests, there is a fixed income associated from these kind of securities. So one of the characteristics of fixed income securities is that they have predetermined fixed payments, which have a fixed frequency as well. These frequencies are usually annual, semi-annual, or quarterly, but you can find different other kinds of other types of fixed income securities with varying frequency. But the most common type of frequencies are annual, semi-annual, and quarterly. Another characteristic of a fixed income security is that principal is returned at maturity. What do you mean by principal? Principal is a payment that is defined in the indentures or covenants or legal terms and conditions of the security, an amount which is defined in these kind of covenants, and it is mentioned that this amount will be returned at the maturity. So what do you mean by maturity? Maturity is also a date which is mentioned in the terms and conditions of these kind of securities. So it can be 1 year, 2 year, 3 year, 4 year, based on the date of issuance. So let's say it's 1 year. So at T0, you bought the security here. At T1, which is 1 year from now, you will receive principal payment because the security it matured. So one of the other characteristics is the principal is returned at maturity. Third type of characteristic is that these kind of securities are usually debt instruments. What do you mean by debt instruments? Ideally, it's similar to a loan wherein some corporation, be it a national government, be it a state government, be it a global organization, or be it a corporation, has taken some initial money at the very beginning to issue these kind of securities, and then they promise to give you certain kinds of payments as well as a big principal amount at the very end of the maturity of the security. So you can call them as debt instruments or similar to loans. So these are the three primary characteristics of a fixed income security. So now we understand why fixed income securities are called fixed income because of its first characteristics, which mention that there are fixed payments associated with it. Second characteristic is there is a payment at the maturity of the fixed income security, and these securities are usually uh, debt instruments similar to loans. So then now we understand what a fixed income security is. We would ideally like to know some types of fixed income securities so that we can associate better with these kind of securities. One being bonds. Bonds is the most common type of a fixed income security. We will discuss about this instrument in much more detail in the following slides. But for now, we all know that bond is a fixed income security and it's fairly common. Then we hear a lot about treasury notes, treasury bonds, treasury bills. So these kind of securities, they are also fixed income securities, which are essentially issued by the US government. All of these treasury bills, treasury notes, treasury bonds, they are issued by the US government to borrow and spend in their own country. The difference between the treasury notes, treasury bonds, and treasury bills is the maturity. One matures in T notes mature in 2, 3, 5, and 10 years. Treasury bond they mature in 30 years, and treasury bills they mature in um, less than 1 year. So based on maturity, the U.S. government differentiates between the names of these bonds issued by them. Another type of fixed income security is certificate of deposits. So I really like this type of fixed income security because it really helps us understand what a fixed income security is all about, and it's fairly common for a lot of consumers slash retail investors like you and me to have already invested in these fixed income securities. So So they are called certificates or deposits, or in some countries, such as India, they're called fixed deposits or FDs. So CDs or FDs. So what happened in these certificates of deposits? You go to a bank or a credit union and you give them a certain amount of money. Let's say you give them $100. The bank will or the credit union will tell you that what is the interest rate based on tenures. Different frequencies will be told to you. So for example, bank will tell you that there's a 5% interest for 1 year. So so you will give bank $100, and at the end of 1 year the bank will give you $105. This is a fairly basic example, but it gets complicated as you move on. So bank might also tell you that now this 5% is 1 year, but it's compounded quarterly. So then you will receive four payments within a year. And then how to calculate these payments, it comes in later stages of this discussion. But this is another type of fixed income security which is fairly common among retail investors or consumers like you and me. Then another type, common type, is called preferred stocks. So a lot of you, when you hear about this preferred stocks, you might say, well, stocks don't give you a fixed payment, so to speak. So why are they called fixed income security? Then I would like to highlight that there are broadly two types of stocks. There are common stocks, and then there are preferred stocks. Well, in the preferred stocks, you are actually told what percentage you would be receiving every year, every quarter, so to speak. The frequencies are pre-decided, and these pre-decided payments happen only in preferred stocks, and they happen in the form of fixed dividends. So they are in essence similar to, they are essentially a fixed income security because there is a predetermined fixed payment associated with it along with the frequency. And they work similar to a debt instrument. So that's why again preferred stocks are a type of fixed income securities. So, well, now we understand the common characteristics of a fixed income security and some of its types. Now we need to understand what are the benefits or problems associated with these fixed income securities, and why do we essentially buy these kinds of instruments or invest in these kinds of instruments. Well, because of its very first characteristic, which was predetermined fixed payments, the benefit of the fixed income security is steady fixed income. Why? Because your payments are predetermined and they are fixed. So we have predetermined fixed payments. Hence, there is a steady fixed income, so to speak, that's coming from these kind of instruments. Then we have option no volatility. Well, if you already know uh, what payment you are going to receive, and you also know the frequency of that payment, so well, there is no volatility, so to speak. So if you plot it on a graph, your payments on the y-axis and the time on the x-axis, you already know that what your payment will be over time. So it can be a straight line, or it can increase or decrease, and then it can increase again. But nonetheless, you will know this before buying the instrument. You will know this in advance. So that's why there is no volatility, so to speak, sudden volatility, so to speak. Then another benefit of the fixed income type of securities is that they're bankruptcy proof better than common stocks. Well, the common stocks value can go to zero. And if a company goes bankrupt, so for example, let's say in the fixed income security, it's a very, very basic example. There was $100 there, and in common stocks, there was $100 again. The company went bankrupt, and now after selling off all of its assets, you receive only $110 out of selling everything from the company. Well, guess what? First, the $100 will be given to fixed income securities, and then whatever is left will be given to people holding the common stocks. So you see, the fixed income securities are better covered than common stocks in case of bankruptcy. And The other case, other being that had you sold all the assets and you would have received only $50, then this $50 would have been spread towards fixed income security holders, and the common stockholders would have received only $0. Hence, um, it is much more bankruptcy proof than common stocks. This is one of the benefits uh, of fixed income securities. Now, what are the problems associated with it? Lower returns than stocks, limited upside. Well, if you have ever seen a stocks graph, it usually goes up, down, but in the long run, it keeps on increasing. If it's a good company, it might go again, it might go down or up, but in the long run, it'll keep on increasing if it's a good company, right? So there's a high probability that you might get a lot of money out of a single investment in a stock. But in the bonds, because your payments are fixed, we've already discussed this. So you already know the payment structure here. Your payments are already fixed. So even if the company is doing very, very, very well, even then you will still receive this kind of payments or this kind of payment based on what was already mentioned in the terms and conditions of your security. So you might receive this first kind of payment or second, but you would know in advance, and this payment structure will not change for fixed income securities. Whereas for stocks, if you go to the second graph on the left, we see that if we bought the security, let's call this time T0, then there might be a time when we are sitting here, which is a lot of money. Let's say it goes up to 10x. We still can get a 10x return from the stock, but not from the bonds. Then the second risk is inflation risk and the market interest rate risk. The two risks. So inflation risk. What is inflation risk? Well, let's take a very basic example, and you know that you are going to receive $10 at T1, you're going to receive another $10 at T2, you're going to receive $10 at T3, and at T4, you're going to get your principal amount plus a $10 fee. So you know your payment structure well in advance for your fixed income security, and this is your payment structure, and this is your frequency. Well, um, things get expensive as time passes. Usually they get expensive. So so the $10 here, the amount of stuff that you will be able to buy from this $10 will be higher than this $10. Why? Because in the long run, things get expensive. So if we increase the difference between this T1, T2, T3, T4, let's say the difference between them is 2 years, 2 years, 2 years. So 4 years from now, the amount of let's say candies you can buy, the number of candies you can buy from 10 $10, which is 4 years from now, will be less. Whereas the amount of candies you can buy right now from these $10 would be relatively higher than what you can buy at T3. So broad understanding is the inflation risk. So these payments are not increasing with the increase in prices of the goods and services that you're going to buy. Because of that, these payments are subject to inflation risk, which means that your buying power will reduce because your payments are fixed and the things are getting expensive. Inflation. So this is fairly basic example. Again, inflation can also reduce, which means your buying power can increase, but that is a whole different phenomena. But we're talking about problems here, so we'll consider that the inflation is increasing, which means buying um, everything is getting goods and services you're going to buy are going to get expensive, and having the same amount dollar amount of value 4 years from now, 2 years from now, is going to reduce your buying power. So let's say this, your buying power is reducing, okay. And the market interest rate risk. Another problem, so to speak, with fixed income securities is that the fixed income securities, its value, it decreases as market interest rate increases. This happens only between the time of when you bought the security and till the time it matures. Now, why does this happen? Well, um, well, because you're getting all the payments which are same essentially, or you know the payment structure of these payments. Um, you also know the return on these payments, the return on these payments. So it's fixed. The return on the payments is fixed. If the market interest rate increases, which is the market is giving you more interest on other kind of securities, and this fixed income product is still giving you that fixed rate of interest which you booked at origination, then nobody is going to buy this security from you, because they can invest the same amount of money somewhere else and get higher returns. Hence, your supply remains the same, but the demand for the security reduces. Demand reduces. Hence, the price of the security reduces. We will further look into pricing the bonds at a later stage, but for now, let's understand that there's a market interest rate risk as well. If the market interest rate increases, the fixed income securities value it decreases. And it also happens the other way around. So if market interest rate decreases, then the fixed income value it increases. Hope this clears some stuff out. Don't get overly complicated with this, because we will cover this in later stages of our discussion. As we discussed at the very beginning, that we'll look into bonds a little more in detail relative to all the other different types of fixed income securities. So let's talk about the basic features of a bond. There are five broad basic features, five features associated with a bond, and these features are: issuer, which is who is issuing the bond; par value, we talked about this when we said the principal value would be given at maturity. So this was the par value that we talked about. Then the coupon rate and frequency, the payments that we talked about, those $10 payments that we were using to understand the return, the fixed return and the payment structure, those were called coupon rate and frequency. We'll go for much more into detail to them again. Then the currency in which the bond is issued and in which the payments will be given, and then the maturity date. So five broad features of a bond: who is the issuer, what is the par value, the coupon rate, currency, and the maturity date. Let's go into details of individual one of these. The issuer of the bond. So as the name suggests, we are looking at who is issuing the bond. Who is issuing the bond? There are five broad categories of entities who issue these kinds of bonds. First entity being the supranational entities. So what is a supranational entity? It's a global organization such as International Monetary Fund, World Bank. So these are fairly global organizations raising capital and debt for for humanitarian purposes, as well as helping the development of underdeveloped countries, emerging economies, or developing countries, financing projects in these sort of countries. So these are global organizations issuing debt. Then we have sovereign national governments. So there are also cases where there are a lot of cases essentially where national governments issue bonds, because they want sudden influx of money so that they can invest in projects which can further give them a lot of money later down the line. So that's why these kind of national government issue bonds. The examples being the US government's T-bills, T-notes that we talked about. In India, we have Bharat Bond, which is another example of a national government's issue of bonds. So these type of bonds are backed by the guarantee of the national government, and hence are considered relatively safe. And in most cases, like in the case of US, these kind of bonds are considered risk-free, because for these bonds to not pay out, the entire US government will have to fail. Um, which is highly unlikely. Hence, these kind of bonds are called risk-free bonds. Then we have the non-sovereign governments. The non-sovereign governments are government entities but they're not national governments. So, for example, the state government. So, for example, the state government of California wants to raise money for a dam project. So, they can issue their own set of bonds and borrow money from the market. And then these kind of entities, they would be called non-sovereign governments, but these kind of entities again are backed by the national government. Quasi-government entities. So the other fourth kind of entities is quasi-government entities. These are these are entities which are not essentially backed by the government or the central bank. They are not liable for these bonds, but most of these entities are related to the government in some form or the other. How are they related to the government? Usually, it's a partial or full ownership of these entities by the government, but yet again these are not guaranteed by the government. But these kind of entities and the bonds they issue, they are considered low risk. Why they're considered low risk? Because historically speaking, if a government has a part ownership or full control over an entity, it there is an implicit guarantee, not an explicit one, that the governments won't let these institutions fail. So that's why they are considered relatively low risk issuers, and hence their bonds are considered low risk bonds. And the last kind of issuers that we talk about is the corporations. So these corporations can be corporations like financial corporations or non-financial corporations. For example, Coca-Cola, Pepsi, Hindustan Unilever. So all of these companies, Tata, Reliance, in fact, Facebook or companies like these, they can raise debt financing through issuance of bonds, and then these issuers are called corporations. Then we also have this basic feature called par value. So what is the par value? If you see a bond document, it is consisting of indentures or covenants, or to be very simple, we can say TNC, terms and conditions. In those terms and conditions, there is a specific value which is said to be paid at the time of maturity. This kind of payment, it's called par value. It is also known as principal value. There are multiple names for it, which would be really helpful if you recognize them in the later stages of understanding how bonds are priced and the current market price of the bonds. So this par value is also called principal value. It's called maturity value because it is given at maturity. It is also called face value, and it is also called redemption value because when you give back the bond at the end of the maturity, this is the value that you redeem from it. So redemption value, face value, maturity value, or principal value. Then we talked a lot about maturity. What is a maturity of a bond? So these are again mentioned in the terms and conditions of a bond document. Um, it tells us when that principal, par value, face value would be given back, and the would be given back, and the bond would be nulled, i.e. the bond will no longer exist. Bond will no longer exist. Based on when the bond matures, there are broadly two types of bonds: the money market bonds, which are short-term bonds and maturity are less than 1 year, and the capital market bonds, which have maturity greater than 1 year. So based on when they will mature, we have segregated the names of the bonds. So one is called money market for maturity less than 1 year. One is called capital market for maturity greater than 1 year. So we talked a lot of the payment structures, those $10 payments that we were using as examples. So what are these $10 payments? These payments, and then at the very end we see it like principal plus plus another payment, $10 payment. So what are these $10 payments? These $10 payments are called coupon payments. They are called coupon payments. This sort of an interest on the amount that was borrowed there. So you can consider this, you can simply understand it as interest paid on the amount borrowed, and principal value is like that amount is returned back, and these individual payments are called coupon payments. And the interest rate, instead of calling it interest rate, now we will call it coupon rate. Why? Because now it is telling us how much coupon we will receive off the principal. So if the coupon rate is 10%, so off the principal, which is $100, you will receive $10 as a coupon payment. So 10% of your par value, face value, principal value is $10. So that's why that is your coupon payment. Based on the type of coupon payments, we have again segregated two types of bonds. One is called plain vanilla conventional bond, wherein the coupon rate is fixed. So you're told as 10%, you will receive 10% of this principal value, $100, at different time periods. So you'll be receiving $10, $10, $10. So these kind of bonds, which are fairly simple, these are conventional bonds. So we call them conventional bonds, and they have fixed coupon rate. Then another kind of bonds that we have is this zero coupon bond or pure discount bonds. So they also give you interest, but they give it to you in a different manner. So how? What is that manner? So they will give you $100. They tell you in the document that they'll give you $100 at maturity. But for now, they will not. When you buy this security, they will not take $100 from you. They'll probably take like $85 from you. So at the time of maturity, you're getting extra $15. So you're getting $85 plus $15, so a total of $100. So this extra $15 acts as an interest payment or a coupon for you without giving you a coupon. You understand? So this is the reason why they call zero coupon bonds, because there is no coupon payment. But in order to compensate you for the amount you have loaned to the corporation or any issuer, they give you more than what you loaned. So if you loaned $85, you will get 85 plus 15, $100. So you're still getting interest on the payment, but not in the same form of coupon. So that's why these are called zero coupon bonds or pure discount bonds, because these bonds are sold at a discount. It's $100 instead of $100, they're borrowing only $85 from you. No coupon, but bond issued at the account. So this is the coupon payment. And the last characteristic that we should look at is the currency. It's essentially in what currency you'll be receiving your coupon payments, and what currency you'll be receiving your in principal payment in. So there are certain kinds of bonds called dual currency bonds, in which your coupon payments, they are given to you in one currency and your principal is given to you in another currency. So your coupon payments, let's say they are given to you in euros, so you're given 10 euros, 10 euros, 10 euros, and then your principal payment is given to you in dollars. So this is a dual currency bond. Then another type of bond is currency option bond, wherein the payments are fixed uh, in one currency, but you can take it in any currency. So, for example, they know the absolute amount of the currency, but you can decide in what currency you want. So you can have the same $10 in INR, and you can take like, let's say it's if it's 75 rupees for every dollar, then you can take 750 INR. So you'll given this new payment in a different currency. So this is called currency option bonds. And obviously then there are very simple bonds as well, in which the currency of the bonds, like the ones we have discussed here, they're already mentioned at the very beginning, and it's in only in one currency. So you will receive $10, $10, $10, and $100 plus $10. So the currency is not that complicated in that third type. So this is pretty much it in terms of basic features of a bond. In the next discussion, we will bring together all of these characteristics of a bond and work out a good example to understand the payments we receive, and also the principal amount we receive from these bonds. So I think that would be really helpful. But till now, this is the fairly basic structure of bonds. Hope you enjoyed it. Thank you.